What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over the CPI report, otherwise known as the Consumer Price Index. We're going to talk about what it means to you, what it means for the stock market, and what does it measure. So the CPI report measures a monthly change in price paid by consumers. So every month we will get a report from the BLS, or the Bureau of Labor Statistics, and it gives us a weighted average of a selected basket of goods that is measured month over month in price change. So let's give you an example of what that measures. It measures a basket of goods, which means that it measures items like food, cereals, non-food items like energy, fuel oil, electricity, shelter. So it will go off rentals, how much people are paying for rent, new vehicles, everything including healthcare and education. So as you can see, it's everything between both services and products. So the CPI report will take a weighted average of all these things, and it will give us a number every month of how much these things are going up or down in price. Now, if you lived through 2022, you'll know that 2022 was a year in which inflation was rapidly increasing. And the CPI report is the number that people look for in order to measure the inflation that's going on right now. Over the last 10 years or so, our inflation rate in the United States has been right around 2%, right until 2022. 2022, we saw a dramatic rise in inflation. In fact, it started kind of happening towards the end of 2021, but then it suddenly hit really hard in 2022 where we saw hyperinflation. Now everybody's wondering, where did that come from? How did we suddenly go from an average of 2% to suddenly going to a high of 9.1% in inflation? And now we're in 2023, so people are wondering if this trend is going to keep going. So let's talk about how we got to the point that we are now before we talk about how inflation and the CPI affect the stock market. So first, let's talk about the power of the Federal Reserve. These people have all the power. So right now, the president or the chairman of the Federal Reserve is Jerome Powell. And Jerome Powell led us through the COVID-19 pandemic, and he led us through the market crash of 2020. When he was taking action to kind of preserve our economy from the COVID-19 pandemic or the crash that we saw, he dropped interest rates to near historic rates, which is near 0%, which is one way that the Federal Reserve controls how much money is in and out of the system. Some other ways that the Federal Reserve will control how much money is in the system and out of the system are going to be the percentage of reserves that banks hold in their reserves, and finally the open market operations. So they're buying securities such as treasury bills by increasing and decreasing the supply of money in the markets. So during 2020 and 2021, we saw a rapid increase of money supply in the markets. This created hyper demand, which then translated into hyperinflation, which we can see clearly in the numbers here. So let's talk about what all this means for stocks. First, we want to address the fact that inflation naturally scares people from owning high-risk assets. Stocks are considered high-risk assets naturally, so people will start selling their stocks when inflation is going up because they start preserving that money into lower-risk assets such as bonds, and they also start spending that money on things like groceries because the bills are getting way too high to afford the normal things. So people start selling their stock, which will naturally bring the market down. You can see that during 2021, the second half of it, and the first half of 2022, the market was coming down sharply as inflation was peaking. So as inflation began coming down, we saw the market starting to rise again, which is now going to be the trend that we're expecting in the future. However, there's one thing that we should take note of, and that's going to be interest rates. So remember, the Federal Reserve controls the discount rate or the ongoing interest rates. Historically speaking, stocks do not like high interest rates because high interest rates make it very expensive for technology companies, especially, or any company, to grow. Because remember, many companies are relying on debt in order for them to grow, to hire. And so if inflation is starting to make the Fed raise interest rates, so the Federal Reserve will raise interest rate in order for people to stop spending. If interest rates are high, people are less inclined to take out loans, to buy cars, to buy credit cards or use credit cards. So all these things become factor for higher interest rates, therefore slowing the economic growth. So as long as inflation remains high, the Federal Reserve will likely continue raising interest rates. And if they continue raising interest rates, it's going to make it harder and harder for people and companies to borrow, to hire and grow their balances, grow their finances. So all these things will start to hinder on earnings. And if company earnings don't come in line with expectations because of high interest rates, that means their bottom line is getting hurt by the fact that they're paying so much in interest, therefore affecting their earnings and affecting economic growth in general. So the trend going forward is you want to keep an eye on both the inflation rate and the interest rates. If interest rates remain flat and the Federal Reserve don't continue raising interest rates, and at the same time we continue seeing the rate coming down of inflation, that's a good sign. We want inflation to start moving towards the 2% rate and interest rates to remain roughly below 5% for people to start really liking those high risk assets again. If people and investors see that inflation is continuing to be stagnant or it's going up, then we can expect the Federal Reserve to raise interest rates higher. Therefore, it will bring the market lower. So if you're looking for a market reversal, if you're looking for a market rally, it'll come at the time in which inflation slows down and the Federal Reserve say, okay, no more interest rate hikes. In fact, we're going to start looking at lowering the interest rate in order to stimulate spending once again. But as long as inflation is stagnant and interest rates are going higher, the market will continue coming down. Before I close out this video, I just want to say that always remember that markets are forward looking. So when you're looking at the current numbers, make sure you're creating a future trend for yourself. The market will move based on what they think will happen in the future, not right now. So if you're looking at inflation numbers and you're seeing slow coolness in inflation, then it's maybe time to start looking at a market reversal, which is something that we can be seeing right now. So inflation has been coming down and cooling down, which is a good sign. That's why the market has been going up, and interest rates may not be going much higher in 2023. So that's a good sign from the Fed, or for the Fed, to stop raising those interest rates, therefore causing a market rally to come.